If you're in the startup world or the VC world, you know that a lot has been said about the potential of Africa. At the beginning of 2023, there was a lot of buzz about the attractiveness of the African continent. And I remember reading an article talking about how Africa has a young and rapidly growing population, and this combined with advances in technology and mobile connectivity, the continent has become an attractive destination for entrepreneurs and investors alike. Naturally, everyone got excited, but 2023 did not become as rosy as we expected. Other experts had already predicted a slowdown in funding for 2023, and that happened as expected. Venture capital was insanely difficult to find, and news of fire sales, layoffs, and startup closures echoed around the continent. It was very rough. With the overall amount of VC funding raised in Africa decreasing significantly across the year, according to initial reports, after steady growth over the last decade, startups and scale-ups in the continent have suffered far-reaching consequences. Unsurprisingly, growth stage startups suffered the brunt of the market correction that came on the heels of a season of bountiful funding and high valuations. Companies such as South Africa's Where's My Transport, a mobility startup, and Sendi, a Kenyan logistics company, shut down after failing to raise fresh funding. Where's My Transport had raised $27 million from heavyweights including Google, SBI Investment, and Toyota Corporation. Sendi also counted Toyota in its investor lineup, which also had Atlantica Ventures leading its $20 million Series B round in 2020. They were not the only victims, as tens of other growth stage companies were forced to scale down operations, and the mantra changed from growth at all costs to profitability at all costs. So what did we learn from the funding winter, as it is dubbed? The funding winter served as a test to show us what works in the African context. For example, the tough times have revealed that B2B e-commerce companies have mostly had unfavorable unit economics and high burn rates. This has called for new approaches that guarantee higher margins to make money, like optimizing logistics or selling high profit margin goods. It comes as no surprise that huge funding rounds cannot save flawed business models. Founders need to put more effort into studying the local market, hold off on raising huge amounts of capital, and only focus on getting little capital to get to product market fit and go to market fit. This is to establish profitability first and only raise to grow. Building a large company in Africa takes time, and the time frame usually falls outside the parameters of foreign funds. This is a measured and longer approach than that of mature ecosystems. Building in Africa also means that to create a large market, operating in multiple countries is inevitable, demanding adaptable business models. This typically means that the journey of finding product market fit and go-to-market fit takes longer than in the United States. Customer trust in Africa takes longer to build. Talent depth and breadth take longer to build because it's a young ecosystem. Thank you so much for joining me for this episode of the Disruptor Journals. Again, I encourage you to subscribe, rate the podcasts, leave a review, connect with me on social media at the Disruptor Journals on Instagram, and subscribe to the newsletter. The link will be in the description. Thank you so much again for joining me. This is Cliff Nemachena signing out.